Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar traded quietly throughout the week, though steady buying interest remains evident in the short-term charts. This behavior is characteristic of large players who gradually pick up the depreciated asset after the downturn, seeking not to move the market at this stage. The rise in U.S. and European index prices and the pressure on gold suggest that we are seeing a return of capital to the U.S. markets. It remains to be seen if this is a recovery from the shock or temporary respite. The dollar's decline since the beginning of the year has created an oversold scale from which rebounds or extended periods of consolidation historically follow. However, our analysis also shows that a new wave of declines usually follows an initial bounce. It is usually less intense, but still strong enough to push the rate to new lows. A straightforward strategy is to look for divergence between the RSI and price on weekly timeframes. A buy signal occurs when the price forms a lower local low, while the relative strength index forms a higher low. U.S. indices rose for the second week in a row, with the Nasdaq 100 up more than 3% and the S&P 500 around 2.5%. Wednesday proved to be a watershed day, with a 2.5% intraday dip towards the end of the day, redeemed by a 4.3% rally over 7 hours. The decline was driven by headlines reporting a contraction in the U.S. economy during the first quarter, widely viewed as the first alarming sign of the trade war's impact. The trade wars did affect these indices, but in a slightly different way. U.S. buyers sharply increased imports, the cost of which reduced GDP. This has been the main negative driver. The other force was the reduction in government spending, something Elon Musk and his Doge had a hand in. In other words, the data is not as bad as it seemed at the outset. On the bullish side, strong earnings reports from major companies helped lift the market. Tech giants like Microsoft and Meta saw their shares rise by 8.3% and 6%, respectively, following their quarterly results, pushing the Nasdaq 100 closer to 20,000 and the S&P 500 near 5,600. Even though fear is still in the market, the S&P 500 has clearly broken above the downward trend line that started in February. Following a 9% rally over the past 8 sessions, it is now consolidating above its 50-day moving average. Pressure on gold intensified at the end of the week. After a period of consolidation earlier in the week, strong moves returned in the second half. The beginning of April was for the bulls, while the last couple of weeks were driven by the bears, who are testing the $3,200 mark. This pullback has brought the price back to the mid-April consolidation area. If the market continues to move down the same steps, the next stop will be the area of $2,900. In this case, however, the price will already be trading below the 50-day moving average, indicating a break in the uptrend. An acceleration of the sell-off could quickly take the price to consolidate to the 2,600 to 2,700 area. Silver is having a tough time with gold in the proximity of its own historical turning point. The price reversed downwards in 2012 and 2024 as it approached the $35 per ounce level. And between those dates, it was strongly lower. That is, strong internal resistance coincided with gold's growth fatigue. However, the strong rebound in silver after its April setback supports a positive outlook, not just for silver, but for gold as well. The crypto market spent most of the week in a narrow range, but surpassed the 3 trillion capitalization level in early May, adding almost 4% over the past 7 days. This is an attempt to overcome the psychologically important round level. Just above this mark is the 200-day moving average, which acts as an important benchmark for large funds and trend-following traders. A consolidation above this level could reinforce the buyer's position and pave the way for a broader market rally. Bitcoin is one step ahead of the rest of the market, already having a foothold above the 50 and 200-day moving averages and a return to the highs from late February, having climbed as high as 96,000. BTC USD is on the cusp of entering the consolidation area of the past winter. The failure of March and April likely recharged buyers. An attempt to retest the all-time highs above 107,000 is the next reasonable target. Success could quickly translate into an active retracement of the all-time highs. In the upcoming week, focus will shift back to monetary policy, with key interest rate decisions expected from both the Federal Reserve and the Bank of England. On Wednesday, Powell and company are expected to keep the key rate unchanged, but the intrigue is all about signaling how soon to expect policy easing. The main obstacles are extremely high inflation expectations and forecasts of real price rises due to tariffs. The Bank of England is set to announce its policy decision on Thursday, with markets anticipating a 4th rate cut in the current cycle, bringing the benchmark rate down to 4.25% from the current 4.5%. While the fate of the U.S. tariffs creates the same uncertainty for everyone, it still manifests itself in the form of inflation in the U.S. and economic pressure in the rest of the world. Hence, Europe's response is to cut rates. Friday's Canadian labor market data will be key to assessing the impact of U.S. tariffs on its trading partners. With employment growth forecasted at 22,000, there is a potential for a significant surprise. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.